Welcome back to the Retire Young radio show. I am your host, Joshua David, on a mission to improve financial literacy. If you're just tuning in, Al was shedding some light on how these markets really function. And it all comes down to supply and demand, which is the core strategy that we talk a lot about in these investing classes. And Al, as we get into this next segment, as I mentioned earlier, we have a lot of listeners that want to understand more about how and why the smart money is creating more income than the average public. There's different techniques. There's different strategies that they're using that, the public doesn't even know about. So let's talk about that. Let's talk about those techniques, the strategies that the smart money is using to create income in their accounts.
Well, yeah, when you think about it, really, there's kind of two components to everybody's financial life. One is generating extra cash now, maybe to supplement your income. And the other is just saving for retirement or building your wealth. So you've got kind of two buckets, an income bucket and a wealth bucket. And if you need cash now, then there are strategies for that. There are short-term strategies. If you're looking at building your wealth, building up a portfolio for retirement for your later years, that's a different way of investing. That's more long-term. And there's the important thing is to get the proper knowledge and the way to use the different strategies that are available for both. And the real important thing is this, Josh, no matter what asset or strategy that you're using, do it the way the pros do. We kind of look at having our students become masters of copying. And when you're in school, of course, you weren't supposed to copy. But now in the financial markets, that's the best thing you can do. Copy the people, copy the pros, the smart money, because they know what they're doing, and they're participating on a consistent basis, which is really important. And when you think about this fact, the institutions, the banks, the big players, they control 70 to 80% of the trading activity, which means that oftentimes if you can't identify what they're doing and follow them, you're trading against them, and that's what we want to eliminate. Even in 2019, for example, the top banks controlled 78% of the foreign exchange market. So why would you want to be on the other side or trade against them?
And sorry to interrupt you. It's shed some light on that. There's roughly $5.5 trillion traded per day in the forex market, right. And if that's 78% of that, that's trillions with a T of dollars.
Correct. And the sad thing is that most of the public has been conditioned to look at basically one investment, and that's stocks, whether it's individual stocks or mutual funds, or maybe it could even be an annuity. And that's actually the smallest market. The stock market is the smallest of all the financial markets, and it's not the only thing that the institutions use. One of the reasons that there's a difference in the amount of returns that the pros get, and the fact that they're more consistent, is simply because they're doing something different. They're not just certainly not in mutual funds, but they're not just investing in stocks. They're investing in short-term trading vehicles. And again, if that's what you need now, if you need additional cash now, then you can't wait 10 or 20 or 30 years to access it. Maybe you need it on a weekly basis, or maybe in some cases a daily basis. It means trading something that is short-term. That's what the institutions are doing. They're out there daily trading, and they're not, for example, putting together a long-term buy and hold strategy one day and then just sitting around doing nothing for 10 or 20 years. They're trading on a consistent basis, things like the futures market, the foreign exchange market, the options market. Those are the short-term trading vehicles that allow the pros, the institutions, to access or have access to cash on a short-term basis.
And just to clarify that as well, Al, a lot of people think short-term, think they're placing a ton of trades at one time.
Right.
Like back in the day where, buy, sell. There's a lot of emotion that way. And how they're placing their trades, they have an entry point, they have a target, and they have a stop loss. So they're protected on both ends. So then they let their investments and their trades work for them.
That's correct. Yeah, and depending on you individually, because everybody's maybe a little different in what they're looking at, what their goals are, but a proper education really should address all of those different components, all of the different trading strategies, all of the different assets, and allow you to kind of customize or have something customized to you. That's part of that plan. That should be customized to each individual, so everybody might have a plan that's a little bit different than somebody else. This is not a one-size-fits-all market, and that's one of the problems. I think Wall Street puts everybody kind of in that one-size-fits-all cruise control kind of a strategy. Let's put together a portfolio of stock or mutual funds, and then don't worry about these corrections. Don't worry about the crashes. The market always comes back. And it does. And we harp on this almost every week. That's lost time. When the market does go down, it takes a period of time for it to come back. If you were in the market in 2000, the year 2000, you put a portfolio together at that peak point in 2000, it took you 14 years for it after two major corrections to get back to where you were in 2000. That's 14 years. And I don't think anyone that is listening was around in 1929. But
are you sure?
Well, no, I'm not sure. It maybe one, I don't know, but not very many. But if somebody invested in 1929 before the major market crash that preceded the Depression, the Great Depression, it took 26 years to get back to where it was before. And when you look at a bear market is a drawdown of 20% or more. And bear markets peak to peak typically last 1,542 trading days. There's 252 trading days in a year. That means 6 years. On average, if you let your portfolio be taken advantage of in a negative way by a bear market, that's lost. Those are 6 years of lost time where, the older you get, the fewer periods of time like that you have to experience.
Yeah, that was some pretty good math there, Al. You must have been practicing that, haven't you?
I might have read that somewhere, Josh.
There you go. Well, I just want to, just talk about that stuff too, because think about this. You were talking about it takes time after the market drops, but here's the problem. These markets it's like a slingshot right now. They're dropping and they're coming right back up.
Correct.
But here's the great thing is there's a lot of opportunity there when the markets move so quickly. It's just understanding that you have a plan, which is what the institutions or the smart money is doing. It's not one size fits all. If you have a custom plan to create income like the smart money does, you have what you need, right?
Right.
And that's why you have to have a custom plan for yourself. Al, I want you to just kind of clarify. You're talking about these down markets, and a lot of people think that's bad. Mm-hmm. And we said in the beginning of the show that there's opportunities there. So talk about what shorting is real quick. Let's keep it high level, 10,000 foot view. Then I want to get into the different asset classes that you're talking about as well.
Yeah, in these classes, we go into more detail on these things. We have a limited amount of time now to do it. But when the market is crashing, whether it's going through a correction, which is a 10% or greater drawdown, or a bear market, which is a 20% or greater drawdown.
Or even these big drops that we're seeing per day, those are just drops that we're seeing. So as markets fall.
Correct. Absolutely. There are ways of participating in a down market. And most of us are just used to the up market being the only way that our portfolios are going to go up. If you're in a stock portfolio or a mutual fund portfolio, the market or that asset has to go up in value for you to profit. What if it doesn't? What if it's going down? Are there ways of profiting in down markets? Yeah, there really are three. One is shorting. That's probably the most commonly used by the big institutions. And that's basically, for us as individual investors, it's basically borrowing a stock or an asset that we don't own, selling it with the intention and the commitment to buy it back or return it since you borrowed it, sell it at a higher price, buy it back at a lower price. Your profit is the difference between what you sold it for and what you bought it for. It's actually just the opposite of what we typically do when we buy a stock. We want to buy it at a low price and sell it at a high price. You're just kind of doing that in reverse, but you're borrowing something to do it. And then you have a commitment to return it, obviously.
Yeah, and a lot of people, anybody talks about trading and investing, they say, oh, I buy low and I sell high. Well, that's one opportunity.
Right.
There's another opportunity. It's sell high and buy low. It's just the opposite to make it real simple. So let's talk about those other asset classes. Al, let's get into the futures market. We mentioned the Forex market earlier briefly, but let's dissect what those are and why the smart money is constantly using that with the stock market.
Yeah. Before I go into that, I just want to continue that downward market issue, because when we mentioned shorting, I also mentioned there were some other ways to do it. Options can be used in a market that's going down or an asset that's going down in value. Inverse ETFs, an exchange traded fund, which is like a mutual fund. It's a basket of stocks that mimic something. There are inverse ETFs that go the opposite direction of that underlying. So those are a couple of ways that you can participate in a down market. Some of those assets can also be used in a sideways moving market. But let's talk about the futures, Forex, and options market. Those are what we call leveraged assets. Those can be used for more short-term cash accessing. And the futures market basically is comprised of a number of things, a number of different opportunities where you are looking at what something will be worth in the future. Will it be worth more? Will it be worth less? So you can participate with the futures in both directions in the market also. But we're looking at the major stock market. So if you want to trade stock, if that's kind of your go-to, you can trade all the major stock markets with a futures contract. You can also trade commodities. You can trade oil, gold, silver, precious metals, interest rates, currencies, a number of different things, and many of them which are not all correlated to each other. So you've got great diversification potential there. But leverage is a big part of these assets. We call them leveraged assets.
And that's buying power.
That is buying power, right? It really lowers the financial barrier to entry for a lot of people. So it's sort of like having a mortgage where you put maybe a down payment of $20,000 and then you have a $200,000 or $300,000 home. You've got a $200,000 or $300,000 investment for $20,000. That's leverage. You can do the same thing with these assets like futures and Forex. Futures trades almost 24 hours a day, which gives great opportunity for people that are tied up during the stock market hours. Forex, that's the foreign exchange market where you're looking at the difference in exchange rates between two different currencies. You trade that as a pair. That is open 24 hours a day. It has great leverage, 50-to-1 leverage. Again, the brokerage firms will allow a smaller amount to be in a portfolio, but to trade with that leverage, which is a great benefit to a lot of people. The liquidity is great there, and that's an important thing, too. You mentioned earlier that the Forex market trades over $5 trillion a day. In other words, you should never have a problem finding somebody that will buy or sell from you or to you.
Yeah, now think about this. A lot of our listeners probably work during the day. We have a lot of 9-to-5ers that listen to the show. And think about this. The futures market and the Forex market. So let's go to the futures market first. You were mentioning you can trade the stock markets, the S&P 500,
right,
the Dow, the NASDAQ. So that the people that like stock, you can still utilize that in the futures market. It's just something a little bit different. It's not new. And think about this as well. If you have a market that'll allow you buying power, like in the futures market, roughly 20-to-1, you said 50-to-1 in the Forex market. So for every dollar, you can control 50. Now think about that. Now, I'll let people do their own math, but I mean, that's what you can do with these other markets. So coming up next, I want to dissect retirement accounts, retirement strategies that the smart money is using. This is Josh and Al. We will be right back.